Imagine Wall Street in the early 1930s. It is not a place of ambition and opportunity. It is a graveyard of fortunes and a wasteland of broken ideas. The great crash of 1929 and the ensuing Great Depression have done more than just destroy wealth. They have shattered an entire generation's faith in the financial system. The euphoric belief in a new era of permanent prosperity lies in ruins, exposed as a collective delusion. The old theories of the market have been utterly discredited, and the public's trust in the institutions of finance is at an absolute zero. Wall Street, in this moment, is an intellectual desert, a place devoid of any coherent, rational framework for navigating the economic ruin. It was in this vacuum, in this darkest hour of financial history, that two remarkable minds came together to forge something radically new. They were not seeking another system for short-term speculation, nor were they offering a magical formula for getting rich quick. Their goal was something far more profound and enduring. They sought to create a rational, evidence-based, and defensive philosophy of investing, a structured discipline that could protect an investor from both the market's irrationality and their own emotional folly. One of these men was Benjamin Graham, a brilliant practitioner and market operator who had been nearly destroyed by the crash and was determined to build an intellectual fortress against such a catastrophe ever happening again. The other was David Dodd, a rigorous and visionary professor at Columbia Business School, who believed that the chaotic business of finance could be transformed into a true, respected profession, akin to medicine or law, with its own set of foundational principles and ethical standards. Together, in the very depths of the Great Depression, they created a book. It was a dense, difficult, and uncompromising text that made no concessions to the popular desire for easy answers. That book was titled Security Analysis, and it would become the undisputed Bible of value investing, the foundational text that would guide the careers of the most successful investors in history. This is the story of how that book came to be. It poses a profound question. How, in the midst of the greatest economic crisis the world had ever known, did these two men find the clarity, the confidence, and the intellectual courage to write the book that would define the future of intelligent investing for the next century? Before we continue, please subscribe and leave a quick comment, even one word. This small action helps the algorithm show this video to more people and tells me these deep dives are worth making. To understand the revolutionary impact of security analysis, we must first immerse ourselves in the world it was created to combat. The financial landscape of the 1920s, the era of speculative mania known as the Roaring Twenties, was a world almost entirely devoid of analysis as we understand it today. The market was not driven by a sober assessment of a business's intrinsic value. It was driven by rumor, manipulation, and a blind, intoxicating faith in upward momentum. The dominant forces on the stock exchange were the great pool operations. These were syndicates of powerful insiders and speculators who would secretly accumulate a large position in a stock, then use a network of friendly journalists, brokers, and paid promoters to spread exciting news and tips about the company's prospects. This manufactured hype would lure the public into a buying frenzy. As the price skyrocketed on this wave of uninformed enthusiasm, the pool operators would quietly unload their shares at immense profits, leaving the public holding worthless stock as the price inevitably collapsed. This was not an exception. It was the standard operating procedure for many of the most popular stocks of the era. The market was a rigged game, and the public did not know the rules. Further compounding the problem was the abysmal state of corporate financial reporting. In an era before strict accounting standards or regulatory oversight, a company's financial statements were often works of creative fiction. Companies could hide debt in off-balance sheet entities, invent revenue streams, and use a variety of accounting tricks to inflate their reported earnings. The numbers that were publicly available could not be trusted. As a result, the very idea of analyzing a company's financial health was considered a quaint, almost pointless exercise. The only thing that mattered was the direction of the stock's price on the ticker tape. The public was not investing in businesses. They were gambling on symbols. The crash of 1929 and the subsequent slide into the Great Depression was not just a financial reckoning, it was an intellectual one. The entire philosophical framework of the new era, the belief that stocks would always go up, that past performance was a guarantee of future results, that valuation did not matter, was exposed as a catastrophic fantasy. The gurus and experts who had championed the bull market were utterly discredited. There was no trusted method left for determining the value of a stock, a bond, or any security. The world of finance was in a state of intellectual crisis, and it was in this crisis that our two protagonists found their shared mission. Benjamin Graham, the practitioner, was a man forged and scarred by the crash. An intellectually brilliant man and a successful money manager before 1929, he and his partnership, Graham Newman, were devastated by the market's collapse, suffering losses of approximately 70%. This near ruin was a profound and formative trauma. It burned away any vestige of speculative optimism and instilled in him a deep, almost religious conviction that the primary goal of an investor was not to make money, but to not lose money. His personal painful experience became the driving force behind his quest for a defensive, risk-averse, and rigorously analytical approach to the markets. He was searching for a system that could protect an investor's principal, first and foremost. David Dodd, the academic, approached the problem from a different but complementary angle. He was a young, ambitious, and highly respected professor of finance at Columbia Business School. At the time, business schools were often looked down upon by the traditional academic establishment, viewed as mere trade schools lacking the intellectual rigor of disciplines like law, medicine, or the sciences. Dodd's great mission was to change this perception. He sought to establish a set of core principles, a foundational body of knowledge, and a rigorous analytical framework that would transform the study of finance from a loose collection of anecdotes into a true, respected profession. He was searching for a way to build an institution. The two men's paths converged at Columbia, where Graham began teaching an evening course on advanced investment analysis. The class was a sensation, attracting some of the brightest and most ambitious minds on Wall Street, all of whom were hungry for a new, logical way of thinking. David Dodd, as a junior faculty member, attended these lectures. He took meticulous notes and immediately recognized the revolutionary genius in Graham's framework. He saw that Graham's ideas, born from the brutal reality of market experience, were the very foundation upon which a new, professionalized discipline of financial analysis could be built. It was Dodd who approached Graham with the monumental proposal. These lectures, he argued, could not be allowed to remain a fleeting oral tradition. They had to be codified, structured, and transformed into a definitive foundational textbook. This book would serve as the cornerstone for the new profession of security analysis. Graham, the brilliant but perhaps disorganized genius, agreed to the partnership. Dodd, the master of structure, clarity, and academic rigor, became the essential catalyst. He took on the immense task of organizing Graham's lectures, contributing his own deep research and analysis, and co-writing the text. Without David Dodd's vision and tireless work, the brilliant but scattered ideas of Benjamin Graham might never have been forged into the single immortal volume that would become known as the Bible of Wall Street. Security analysis was a direct intellectual response to the irrationality and ruin of the preceding decade, an act of profound intellectual optimism in an age of utter despair. Published in 1934, with the financial world still smoldering in the ruins of the Great Depression, Security Analysis was more than just a book. It was a manifesto. It was a declaration of war against the speculative, uninformed, and irrational culture that had led the world to ruin. In its dense, uncompromising pages, Benjamin Graham and David Dodd laid out a complete, logical, and rigorous framework for the practice of investment. They sought to replace the chaos of gut feeling and rumor with the sober order of evidence-based analysis. To understand their revolution, we must dissect the great pillars of their intellectual edifice, just as they would have dissected a corporate balance sheet. The very first and most crucial task that Graham and Dodd undertook was to create a clear, sharp, and unforgiving line between the act of investment and the act of speculation. In the 1920s, the terms had become blurred and interchangeable. Graham and Dodd sought to restore their proper meanings with a definition that has since become legendary in the world of finance. They wrote, "An investment operation is one which, upon thorough analysis, promises safety of principal and an adequate return. Operations not meeting these requirements are speculative." This single sentence is the bedrock of their entire philosophy. Let us deconstruct its three essential pillars. First, thorough analysis. For Graham and Dodd, this was not a casual term. It meant a deep, quantitative, and objective study of a business based on verifiable facts. It meant poring over financial statements, understanding a company's assets and liabilities, calculating its long-term earning power, and assessing the quality of its management. It was the painstaking work of a financial detective, not the excited chatter of a stock market gossip. It meant forming a judgment of a company's value that was completely independent of its current stock price. This was a direct assault on the speculative mindset of the era, which was concerned only with price momentum and market sentiment. Second, promises safety of principal. This is perhaps the most misunderstood phrase in their work. It does not mean that the price of an investment can never go down. Graham and Dodd were realists. They knew that market prices could fluctuate wildly. Safety of principal referred to the safety of the underlying investment itself, a safety derived from the thorough analysis you have just conducted. It meant that your analysis provided a strong rational reason to believe that the business was sound enough and the price you paid was low enough that you would not suffer a permanent loss of your capital over the course of your holding period. This safety was not a hope. It was an analytical conclusion, achieved primarily through the cornerstone of their philosophy, the margin of safety. Third, an adequate return. The word adequate is chosen with deliberate and profound care. It does not mean spectacular, exciting, or quick. It means a satisfactory, reasonable, business-like return on your investment, similar to what a prudent business owner would expect from their enterprise. It is the return of a professional, not the lottery-like jackpot sought by the gambler. Graham and Dodd were explicitly rejecting the get-rich-quick mentality of the 1920s and replacing it with a call for patient, sober, and satisfactory wealth creation. If an operation did not meet all three of these rigorous criteria, it was not a bad investment. It was not an investment at all. It was, by definition, a speculation. With the philosophical foundation laid, Graham and Dodd then provided the central working concept for the security analyst, the pursuit of intrinsic value and its protection through the margin of safety. Intrinsic value is the underlying objective worth of a business, a value that exists completely independent of its daily stock price. While a stock's price is a product of mass psychology, a fluctuating mixture of fear and greed, its intrinsic value is a product of its real-world assets and its sustainable earning power. Graham and Dodd acknowledged that intrinsic value could never be calculated with the precision of a scientific formula. However, they argued that a competent and diligent analyst could determine a reliable range of value. They taught several methods for estimating this, from calculating the liquidation value of a company's assets to capitalizing its average earnings over a number of years. The critical point was that the goal of the analyst was to know what a business was worth, separate from what the market was saying it was worth. This concept then leads to the single most important principle in their entire philosophy, the three most important words in value investing: margin of safety. If intrinsic value is the destination, the margin of safety is the bridge that gets you there securely. The concept is a lesson in engineering-grade prudence. Graham used a famous analogy. If you are building a bridge that needs to support a 10,000-pound truck, you do not design it with a 10,000-pound capacity. You design it with a 15,000 or 20,000-pound capacity. That extra capacity is your margin of safety. It is your protection against unforeseen stress, unexpected events, or a simple error in your calculations. In investing, the principle is the same. If your thorough analysis leads you to conclude that a business is worth $100 per share, you do not buy it at $95. You wait with the patience of a predator until the market, in its characteristic moments of pessimism or neglect, offers it to you for $60 or $50 or even less. That discount, that gap between the price you pay and the value you get, is your margin of safety. This margin serves a powerful dual purpose. First, it acts as a cushion against the inevitable errors of human judgment. No analyst is perfect, and the future is always uncertain. The margin of safety ensures that even if your value estimate was slightly too optimistic, or if the company's future earnings are slightly less than you projected, you are still likely to avoid a permanent loss of capital. Second, it is the ultimate source of investment returns. By buying $1 of assets for 50 cents, you are not just protecting yourself. You are creating the potential for significant appreciation as the price eventually, over time, gravitates toward the business's true intrinsic value. Security analysis was not just a book of philosophy. It was a dense, practical, and highly detailed textbook on how to perform the work of an analyst. The foundation of their practical work was balance sheet analysis. In an era of unreliable earnings, Graham and Dodd trusted the balance sheet above all other statements. They taught the analyst to be a financial detective scrutinizing a company's assets and liabilities with a skeptical eye. Their most famous and extreme application of this was the strategy of buying net-nets. A net-net was a company whose stock was trading at a price below its net current asset value. The formula was simple. Take a company's current assets, cash, receivables, inventory, and subtract its total liabilities, both short-term and long-term. If the resulting number on a per-share basis was higher than the stock's price, you had found a net-net. This meant you were buying the company for less than the value of its liquid assets alone. You were, in effect, getting all of its fixed assets, its factories, its machinery, its real estate, for free. This was the ultimate cigar-butt approach to investing, a strategy only possible in the depths of the Great Depression. But it represents the most extreme and powerful expression of the margin of safety. While they prioritized the balance sheet, they did not ignore the income statement. But here, too, their approach was profoundly conservative. They were not interested in a single spectacular year of earnings, which could be an anomaly or the result of accounting tricks. They were interested in a company's true, sustainable earning power. To determine this, they advocated for averaging a company's earnings over a period of 7 to 10 years. This method would smooth out the highs of boom years and the lows of recession years, providing a much more reliable and conservative picture of what a business could be expected to earn over a full business cycle. Based on this rigorous analysis, they established incredibly strict quantitative criteria for what could be considered an investment-grade security. For a bond to qualify, for example, the company had to have earned its total interest charges at least 5 times over for a period of at least 7 years. For a stock, they demanded a long, uninterrupted history of dividend payments and a consistent record of profitability. These were not exciting rules. They were the boring, sensible, and powerful rules of a professional determined to first and foremost avoid loss. Finally, Graham and Dodd taught that all these analytical techniques were useless without the proper temperament. The intelligent investor, they argued, must cultivate a specific psychological mindset. This includes a deep skepticism, a refusal to take any corporate claim or popular market narrative at face value. It requires emotional detachment, the ability to view the market not as a source of validation or excitement, but as a business partner, the manic-depressive Mr. Market, who on some days offers to sell you his shares at a ridiculously low price, and on other days offers to buy them from you at a ridiculously high one. The analyst's job is to ignore the mood and exploit the price, and above all, it requires discipline and patience. The discipline to stick to your rigorous analysis and the patience to wait for months or even years for the perfect combination of a great business and a low price that affords a true margin of safety. Through this comprehensive framework, David Dodd and Benjamin Graham accomplished their great mission. They transformed investing from a speculative gamble into a rigorous professional discipline with its own set of standards, its own analytical toolkit, and its own required code of intellectual and emotional conduct. A book, no matter how brilliant, is merely a collection of dormant ideas on a page. To give it life, to transform it from a theoretical text into a living, breathing intellectual tradition, requires a dedicated and passionate teacher. If Benjamin Graham was the visionary who first articulated the principles of value investing, it was David Dodd who became the great educator, the man who built the institutional and academic house in which those ideas would flourish and endure for generations. His legacy is not just that of a co-author, but of the master professor who transformed a philosophy into a profession. For decades, David Dodd was a fixture at Columbia Business School, while Graham was the brilliant but often distant practitioner operating in the real world of his investment partnership. Dodd was the man in the classroom, day after day, year after year. He took Security Analysis, the book he had helped create, and turned it into the foundational textbook for a new and rigorous discipline. His teaching style was a reflection of his own mind, methodical, demanding, and uncompromisingly focused on facts and logic. He did not teach his students what to think. He taught them how to think. He trained them to be financial detectives, to approach a company's financial statements with a healthy and pervasive skepticism. He taught them to build their investment cases not on popular opinion or exciting stories, but on a foundation of irrefutable quantitative evidence. His classroom was a laboratory for the mind, where the abstract principles of intrinsic value and margin of safety were honed into practical, real-world analytical skills. Through his patient and tireless work as an educator, David Dodd personally trained a cadre of young investors who would go on to become some of the most successful money managers of the 20th century. He was the central hub, the quiet but powerful intellectual force at the very heart of the value investing universe. The ultimate, irrefutable proof of the power of his and Graham's teachings came on a single day in 1984. The occasion was a celebration at Columbia University, marking the 50th anniversary of the first publication of Security Analysis. The intellectual climate in academic finance at the time was openly hostile to the ideas of Graham and Dodd. The prevailing theory was the efficient market hypothesis, which argued in essence that it was impossible to consistently outperform the market through analysis, as all available information was already reflected in a stock's price. Value investing was seen as an archaic, obsolete relic. Into this environment stepped Warren Buffett, the most famous and successful of all of Graham and Dodd's students. He delivered a speech that has since become legendary, titled The Super Investors of Graham and Doddsville. In it, he systematically dismantled the arguments of the efficient market theorists with a single powerful presentation of empirical evidence. He presented the long-term, market-crushing investment records of 9 different professional investors. Year after year, decade after decade, each of these managers had dramatically and consistently outperformed the S&P 500. Then Buffett delivered the intellectual checkmate. He revealed that all 9 of these super investors, though they operated independently, all had one thing in common. They had all learned their craft directly from Benjamin Graham and David Dodd at Columbia University. Buffett used a brilliant analogy. He said that if you held a national coin-flipping contest by pure chance out of 225 million participants, you would expect about 215 to correctly call heads 20 times in a row. This is not a sign of skill, but of luck. However, Buffett argued, if all 215 of those winners came from the same small isolated village, you would immediately want to know what was in their water. Graham and Doddsville, he declared, was that village. The phenomenal, long-term success of this diverse group of investors could not be explained by chance. It was the direct result of a shared intellectual framework, a common philosophical origin. Buffett's speech was the definitive evidence-based proof that the principles taught by David Dodd and Benjamin Graham were not an accident of history. They were a source of a persistent, structural, and learnable advantage. Beyond the intellectual framework, Buffett has repeatedly spoken of the profound personal influence that David Dodd had on his life. While Graham was the distant, awe-inspiring genius, Dodd was the warm, encouraging, and accessible teacher. Buffett has said that Dodd had more influence on my life than any other man except my father. He praised Dodd not just for his intellect, but for his character, his integrity, and his unwavering intellectual honesty. He was a man who lived the very principles of prudence and rationality that he taught in the classroom. This leads to the final question. Why does a book written nearly a century ago in a world of ticker tapes and steam locomotives remain the foundational text for serious investors in the age of artificial intelligence and high-frequency trading? The answer is that security analysis is not about a specific set of stocks or a particular market environment. It is about the timeless and unchanging principles of business logic and human psychology. The specific examples may be dated, but the core ideas are eternal. The principle of demanding a margin of safety to protect against an unknowable future. The discipline of thinking of a stock as a piece of a real business. And the necessity of protecting oneself from the emotional manias of the crowd are as critical today as they were in the depths of the Great Depression. The legacy of David Dodd is that of the great educator, the quiet architect who gave structure and endurance to a revolution in thought. If Benjamin Graham was the visionary who first saw the promised land of value investing, David Dodd was the master builder who drew the maps, wrote the laws, and constructed the intellectual edifice that would allow generations of future investors to inhabit it. He was the essential force that transformed a brilliant practitioner's ideas into a robust, teachable, and enduring academic discipline. In doing so, he did more than just co-author a book. He helped to transform investing from a speculative gamble into a noble profession. The world of financial markets is vast, and there is no single path to mastery. Today, we have dissected the analytical approach of David Dodd and Benjamin Graham. But do not forget the other great schools of thought. The art of speculation and tape reading from Jesse Livermore, the analysis of market structure and the actions of smart money from Richard Wyckoff, and the deep understanding of time cycles from William Delbert Gann. Each of them offers a unique and powerful perspective on the market. All links to the channels for their in-depth study can be found in the description of this video.